Thank you for joining us today for our Q3 Manufacturing Outlook webinar. We are delighted to be joined by Make UK's Chief Economist, Seamus Nevin, who will be providing an update on the state of UK manufacturing and sharing the results from our latest Make UK BDO Manufacturing Outlook Report. This quarter, we are also joined by Eyad and Herve, R&D and grant specialists from BDO's Innovation and Technology team, and they'll be sharing the latest opportunities available to manufacturers through R&D tax credits and grants.
Good afternoon, everybody, and thank you for joining this webinar today. We'll kick off, as always, with a quick top-line overview of what we'll discuss throughout this presentation and then get into a bit more granular detail as I go on. So the first thing to point out is that both output and orders have decreased sharply this quarter. Export orders are also trending down, while domestic orders are now in negative territory. Prices are down and margins are being squeezed. Investment is now negative, and as a result of that, we have revised down both our sector forecasts for this year and for next year, as well as our macroeconomic forecast for this year and for next year. So there's been a clear weakening of performance, particularly across orders, output, investment, and employment intentions. So what does that mean in detail? If we move on to the next slide, both output and orders decreased sharply. This year, we've witnessed a 22% increase in output in Q1 when stockpiling activities reached the highest level ever recorded in the G7, as imports rocketed up by 11% and warehouse demand increased by an unprecedented 32% in one quarter, followed by a 17% contraction in output in Q2. That was the industry on steroids preparing for the original EU exit date of March 29th, and then a big drop-off after that didn't happen. While it has remained positive for the 12th consecutive quarter, output has nevertheless contracted by 3 quarters when compared to Q2, and that's the circle on the right of the chart there, just to highlight the significance of that drop. In contrast to our Q1 results, our current findings, which also cover a period when we would expect to see the beginnings of stockpiling activities ahead of the new Brexit exit date at the end of October, we're not really seeing much activity in that regard just yet, for reasons that remain slightly unclear, but we have some suggestions as to why we think that might be the case, which I will get into slightly later on. The other key point to note here is that if manufacturing stockpiling hadn't artificially boosted output in Q1 of this year, the industry would already have entered recession or negative growth for the year. As it is, the Bank of England are now warning that uncertainty around Brexit and flowing international trade mean that we may be headed towards a recession. They think there's a 1 in 3 chance of entering recession by the start of 2020 anyway, regardless of what now happens with Brexit. So these are worrying times. In terms of export, what we've seen in Q1, our manufacturing outlook results showed stockpiling activities, as I mentioned, had reached record levels. For the last 2 quarters in a row, domestic orders had exceeded export orders, not because domestic customer demand went up, but because export customer demand went down. Now, this quarter, by contrast, export orders have returned to a level above domestic orders, but unfortunately, this is not because export orders have increased. Rather, it's because domestic orders have now collapsed and are in negative territory at -6%. So these are, again, a worrying signal. For 11 consecutive quarters, domestic, export and total orders have all been in positive, albeit weakening territory. Now in Q3 2019, this marks the first quarter where UK orders have finally turned negative. Our total order balance fell by approximately 3 quarters versus Q2. Exports continue on their downward spiral, having fallen from 12% in the first quarter of this year, then 8% in the second, and you can see the consistent trend down to 6% this time around. Companies are continuing to struggle as export partners postpone or cancel purchases from the UK until they get clarity on what our post-Brexit trade rules will be. Ominously, our results also evidence concerns that foreign customers are switching from their supplies away from the UK and buying goods that they once bought from companies here in Britain from elsewhere as well because of that Brexit uncertainty. And this is happening across the board. Orders from everywhere are declining. Both domestic orders and export orders have contracted, and expectations for the next 3 months are for similar order levels. Unsurprisingly, manufacturers, as you can see from the chart in front of you, continues to see the EU as the most important market. It's where we sell the bulk of our goods that we export. About half of what we export goes to European markets. The export market top three is then completed by North America and Asia, though again, both of those key markets are also declining. The reasons for this, however, I think it's important to point out are not just Brexit. Trade tensions between the US and China are having a clear effect on the global economy. It used to be said that when the US sneezes, the rest of the world catches a cold. Well, if you add China into that mix, it's very, very serious. So the US economy is slowing down, and China has recently reported its slowest growth rate in 27 years, really predating or the slowest growth since their economy took off like a rocket, as it has done for the last almost quarter century. On top of that, there are growing concerns around the Strait of Hormuz. The news headlines in Iran are having spillover effects in the Middle East, and of course the important trade route through there in the Persian Gulf. And then adding into the mix concerns in Argentina, which is a major South American economy, having suffered a significant turmoil following the collapse of the peso there as a result of the recent election results. And the instability that has brought on a key economy in a very important region of the world. Most economists now expect the euro currency area to expand by as little as 0.9%, which is down about 0.5% on the predictions made a couple of months ago as well. So the eurozone is also slowing down, although it is continuing to grow. It's not in recession as such, but again, not heading quite as strongly forward as it was once. And this is having an effect across almost all sectors of the UK. So you can see on your chart three green circles on the bottom line. These are just to highlight the sectors that are in negative territory this quarter. The big one is basic metals. That's largely as a result of the difficulties that British Steel has had. It has, at the time the survey went out, was in quite a lot of turmoil. It has now thankfully been rescued, having been purchased by the Turkish Army's pension fund. But equally in the steel sector, we've seen Tata Steel in Newport in Wales announce that they will be leaving the UK. So two big companies in an important sector really struggling, and that has had an impact across the whole of that subsector, but also a spillover effect onto metal products, which is just to the left of it on the chart there. Obviously, metal products get a lot of their inputs from basic metals as well. And then the third big sector here that's being affected is mechanical equipment. A lot of mechanical equipment uses metal inputs, but also mechanical equipment is really a proxy for investment by businesses. Businesses are currently not investing in new technology, new machinery for their factories, and that's having a negative effect on the overall economy. The one beacon of light, however, if you look to the right of that graph, is electronics. Electronics is a sector that has been consistently outperforming the rest of manufacturing over recent years, and that's a clear sign that it is a sector that caters through the provision of chips and new technologies into the growing demand for automation across the world. So it's continuing to prosper in spite of the rest of the economy facing a lot of difficulties. One other just interesting point there is around rubber and plastics, which has also suffered a big fall versus last quarter when it reported a 60% balance, as opposed to now predicting a negative balance in the next 3 months, which seems to be a result of the growing environmental awareness around the whole Greta Thunberg Extinction Rebellion movement. So that could be one to watch in future editions. Moving on to prices and margins. Sterling fell by about 10% in the immediate aftermath of the Brexit referendum in 2016, before then stabilising. It has, however, since fallen by a further 7% since May, and there's no pun intended there. And it's currently at its lowest level for over a decade and is edging close to parity with the euro. Many economists believe a worst-case scenario of a crash-out Brexit has still not yet been fully priced into the pound, which could mean that further falls might come in future. Some would suggest that a fall in the price of the pound makes UK goods more affordable to foreign customers. Yet the fact is that much of the collapse has, in fact, already been priced in by UK manufacturers from that initial fall immediately after the referendum in 2016. So the benefits for those who would benefit from a fall are less likely to occur this time around. The other key point to note is that much of what we export from the UK is first imported. So about 50% of what we export is imported as component parts. The bulk of manufacturing firms in the UK sit in the middle of the supply chain. So there really isn't a huge amount of gains that can be made from the devaluation of the pound. The biggest outcome from a devaluation of sterling is likely to be seen in inflation, and indeed we have seen inflation accelerate 2.1% since July on the back of strong pay growth in the overall economy. Unfortunately, however, looking at wages, pay growth in manufacturing is not as strong as in other sectors, with a fairly continuous gap in recent times of about 1 percentage point, meaning real earnings in manufacturing have now turned negative. Productivity as measured by output per worker has also decreased for the 4th consecutive quarter. And manufacturers focused on domestic markets are therefore increasingly being squeezed by both the cost of input purchased from abroad as well as by the tightest labour market on record in the UK, pushing up wage costs. Export prices are down by about 8% this quarter, but so too are export orders, signalling again that foreign customers are choosing not to buy as many UK goods as they once did, even though those goods are now cheaper. UK prices have also been cut by about 6%, as have both export and domestic profit margins, meaning firms are beginning to really feel the squeeze. Inevitably, perhaps, the result of all this is that confidence has crashed. The unprecedented economic and political uncertainty in the UK as fears of a crash-out Brexit grow, as well as other concerns to do with Trump-China trade war and the other issues I mentioned earlier, are continuing to seriously undermine the performance of UK manufacturing. We haven't just seen that borne out in the results of the Manufacturing Outlook survey. We also see it in the latest PMI data, which show that business confidence has now fallen to an all-time low on that measure, as customer purchases, which have driven what little economic growth we have seen recently, have also now worsened. In August, production in consumer goods industry dropped at the fastest rate since February 2009, around the peak of the global financial crisis. Employment in the manufacturing sector has also fallen at its fastest rate in 7 years, and capital investments have shrunk too. So really across the board, not encouraging signs at all. And unfortunately, again, a further slowdown is expected, with the level of confidence in the overall economy down by almost a half versus our Q2 results. Manufacturers are not optimistic about their economic future. This is the 5th quarter of contraction in a row, and it is in fact the 7th if you discount the seasonal boost that came in Christmas of last year and happens almost every year. The circle to the right of the chart is just to highlight that this quarter's results represents the biggest gap between output and orders on recent records. Again, adding to the woes of the industry, investment is now negative. As firms have reduced their output, their spending has almost ceased. Both employment and investment intentions have therefore worsened since last quarter, and the Bank of England calculates that investment is now 12% lower than their expectations for this time in 2019, when they predicted late last year. The bank also calculates that UK productivity has been reduced by up to 5% versus where it would have been, and our economy has lost 2 to 3% of growth over the last 3 years, as this whole freeze on investment has been prolonged. For manufacturers, investment in technology and skills training, which are the real engines of economic growth, has been paralysed all year, but worryingly, investment intentions have now entered negative territory for the first time since Q3 2016, the period immediately following the Brexit referendum. Ominously, companies are cutting back on investing in transport equipment, factory machinery, new IT, just at the point in the economic cycle when we would normally expect these things to be increasing. Consequently, business investment is now set to contract overall for 2019, adding to the contraction that we witnessed overall in 2018 as well. And it's not just goods and IT, or machinery and IT equipment that are suffering the consequences of this employment and investment intentions have contracted as well. As has consistently been the case since the Brexit referendum, employment intentions are still higher than investment intentions, with companies more willing to spend their money on recruiting new staff than on other less fungible assets, such as new factory machinery or IT equipment. This is a clear sign, again, of a lack of confidence affecting the sector. Firms are avoiding spending much needed cash on costs that cannot easily be recouped if needed. The number of job vacancies has also been falling, with fewer now than there were at this time last year. In addition to the 6 months of consecutive contraction in the numbers of jobs on offer, as per the 2 previous editions of Manufacturing Outlook, much of what new hiring has occurred in the sector seems to be for part-time and contract workers rather than permanent employees. Again, a signal that firms are not confident about the short to medium-term future. We are, however, experiencing the tightest labour market on record levels of employment, the lowest ever record of unemployment. Has seen manufacturing wages increase by 2.4%, but the labour market tends to be a lagging indicator. It lags the rest of the economy in terms of the results that it reports, and shrinking profit margins and worsening productivity suggest that pay growth may soon start to slow. We're already on track to see the lowest level of pay growth across a decade since the Napoleonic Wars. So what does that mean for the immediate future? Well, manufacturing accounts for 10% of our economy. It's bigger than the finance sector, despite often our common perceptions. So its performance often leads the way in setting trends that we then see percolating through into other areas of the economy. So consequently, the disappointing factory activity this quarter raises fears of a recession. UK GDP has now gone into reverse as our economy contracted by 0.2% this quarter, and we are now at the bottom of the G7 growth league table. To put that in context, the last time our country suffered falling GDP was during the global financial crisis, so it's not something we see very often, but when we do, it's usually a very bad sign. Looking forward, as a result of all of these worrying trends, our expectations are for a 29 in which trade will end in negative growth. The UK will have done less international trade this year than last year, essentially, before hopefully recovering somewhat in 2020, albeit that depends on what happens come October 31st. In numerical terms, the result is that Make UK have revised our forecasts. So from our manufacturing forecast is now down 0.1% for 2019 to 0.1% growth overall, and 0.2% lower for 2020. So we now expect a growth of just 0.6% next year. In terms of the macro forecast, it's also down by 0.1% to 1.1% for overall growth in the economy in 2019, and down 0.2% for 2020. So we now expect an overall growth in the economy of 1.4% in 2020. Once again, however, this forecast is based on a baseline assumption of an orderly exit as opposed to a no-deal Brexit. We shall soon know how realistic that assumption is.
Thank you, Seamus. And now we'll hand over to Eyad and Herve for their presentations.
Thank you, Bob. Good afternoon, all. My name is Eyad. I'm one of the partners within the Innovation and Technology team here at BDO that focuses on R&D tax. And I thought it'd be useful to give you a bit of update on R&D tax. I am assuming in this presentation that hopefully most of the attendants are already aware of the relief. So I'll be talking about a bit of the new changes, some of the stats, how in these uncertain times it may be useful and beneficial to get the most out of the R&D incentives currently available. So just a bit of a background for those of you who don't know, the R&D relief was introduced back in 2000. It was introduced by the Labour government and then enhanced by the coalition. Even recently, after the Brexit vote, there was an increase in the R&D expenditure credits percentage for larger businesses, so the trend is upwards, even post-Brexit. The aim of this relief is to achieve 2.5% of GDP as R&D spend. We're still currently at 1.9%, and we do expect that number to increase. Brexit, of course, there's a lot of uncertainty around it, and this is currently just our own opinion. there's two R&D reliefs, as hopefully most of you know, available in the UK. The one available for larger businesses is not considered a state aid, and therefore we don't see much impact on that. However, the R&D tax relief for SMEs is a EU notified state aid. There is a restriction from the as an EU notified state aid for that being a maximum of 25%. If and when, well, we leave the EU, then the question is, with that ceiling removed, would that percentage be pushed further by the Chancellor? There are some positive signs, looking back at history, in terms of some of the things that the government has done to encourage innovation and stimulus from a tax perspective. So, for example, in 2010, there was allowances from the Chancellor to carry back losses, even those generated from the R&D claims, an additional year compared to just 1 year, and therefore to improve cash flow. Also, with the reduction and the promise to take down the tax rate to 15%, and the R&D tax credits being calculated at 14.5%, there is another sign of emphasis on businesses taking the cash today. Moving on from Brexit, just looking at some of the stats that HMRC release on a yearly basis. These are the 2018 stats that refer to the 2017 numbers. We argue the stats for the 2018 anytime this month. But essentially, there's £3.5 billion worth of R&D relief being given out, giving an average of just shy of, let's say, £100,000, £90,000 per submission. There has been a 22% increase in these submissions for SMEs and a 25% increase in the quantum being given out, which also reflects whether the knowledge of this relief, but also hopefully the ability of businesses or the intent of businesses to spend money on innovation. A lot of the R&D is concentrated in 3 regions, and actually in 3 specific locations and industries. So if we look at the graphs, we can see here that London, South, East, and East England have the biggest number of claims, but also the amount of claims as well. An interesting stat here as well in terms of age of businesses, the next graph, where we can see the spread of actually the younger the business, the more likely they're going to take advantage of this R&D relief, or actually the younger the business, the more likely they're going to be carrying out R&D activities. And if we look at it by sector, and if we focus on the manufacturing sector, you can see it is the highest in terms of amount claimed, second highest in terms of number of claims. So that brings us, of course, to an interesting point. Well, what are the risks of for businesses, especially within the manufacturing and engineering sectors, that are utilizing significantly those R&D claims, especially in the light of the Brexit and uncertainty that we've just discussed. So there are some new legislation that HMRC introduced or are looking to introduce. So, for example, from the 1st of April 2019, all R&D tax submissions have to be done with an amended corporation tax return and a CT600. So it's no longer allowable just to submit a report without the corresponding tax returns. This may result in the claim being returned or rejected, and the statutory deadline still applies. So even another submission doesn't happen within the relevant period of time, it's just the submission of a report is no longer acceptable. It does come from discussions with tax advisors and businesses and HMRC, where sometimes reconciliation between future tax returns and previous amended tax returns become out of sync. The other current consultation also looks at SMEs who have significant spend on subcontracting costs, where HMRC is currently consulting with us and other advisors as to whether to limit the amount of tax credit for businesses that use a lot of subcontractors. It is not intended to put such businesses on the negative side of this, or to discourage subcontracting, it is because HMRC has seen a bit of abuse on this mechanism, right? There's also, of course, the third point, which is because of the rise of submissions of R&D, HMRC has had significant delays. So from a cash flow perspective, the timing of when an R&D claim should be sent to HMRC becomes quite interesting. Trying to avoid periods of time such as December and March may improve the assessment time frame prior to HMRC issuing the R&D credits. Some of the other risks recently, this was actually yesterday, where we've got data from HMRC stating that there has been a misuse of the R&D tax credits and the patent box. So you can see there, and this is by the top 2,000 businesses, but you can see there there's around £200 million that HMRC is assuming is not, it was a misuse from R&D tax or R&D expenditure credits, and just shy of 90 million from the patent box. And we have spotted in the market more businesses approaching us, asking us to assist them, where they have prepared their R&D submissions either independently or with their tax advisors, or with other third parties, where they've asked us to support them with questions that HMRC had asked. We also know that HMRC has allocated specialist software expertise in-house to review these R&D submissions, and this is actually not unheard of. Other countries have similar expertise, and it's actually, from our perspective, it is welcome to make sure that these tax reliefs are actually going out to businesses that are eligible for it, and actually, being able to utilize and use advisors that can really help these businesses in submitting correct and accurate tax relief applications. So these are some of the risks that are currently there, but there's also important in the current scenario to make sure businesses are getting the most out of the R&D where businesses can. So for example, it is important to assess how to preserve the SME status. Of course, an SME can get up to 33% of their R&D spent compared to large companies. And therefore, if a business is looking to get a grant or a subsidy, or even be linked with other entities through joint ventures, through even private equities or VCs, then there needs to be a consideration as to the level of impact. Now, my colleague Herve will discuss grants in a minute, but it is always important to assess the impact, whether there are going to be any R&D tax incentives that are going to be received compared to any other subsidies. Timing, and we already touched upon timing in terms of submitting the R&D tax relief at the right point in time, but also timing in terms of when these R&D claims are being prepared. Although HMRC allows a 2-year window to go back and review the R&D tax submissions, leaving it for 2 years means a lot of the engineers and technical staff may usually forget the detail, which becomes vital as to whether to include an R&D submission or not. Including some software solutions as well have helped some of our clients to identify and increase the eligibility of what they should be including. So including checkboxes on timesheets, for example, allows individuals across the organization to tick that box if that relates to R&D. But with that also comes a little bit of an internal educational piece. So a web page on the intranet about R&D and what's eligible. We're invited to present on some staff updates and have a 5-minute or 10-minute presentation of what is R&D. Also, such activities help alleviate risks or concerns from HMRC when and if inquiries are raised. Of course, on top of that, from an international angle, so like I said at the outset, there's 40 other countries that offer R&D tax relief. Germany is just launching their R&D tax relief system from the 1st of January 2020. But actually, therefore, businesses with locations in more than one jurisdiction should be considering R&D incentives in those jurisdictions as well. But that also starts kind of a conversation and a debate as to where should the R&D be placed? How do businesses with multi-jurisdiction presence in R&D work? And how does that have an impact sometimes on the transfer pricing agreements? Some of the more simpler ways to look at this is, and like we said, comes back to the timing and to the discussions and to actually the individuals assessing those projects. So making sure that a detailed assessment of the projects are carrying out and investigating other areas rather than just the pure manufacturing that may be allowable. Costs, like I said, timesheets, making sure timesheets are included in an assessment, and sometimes even building simple software containers that allow, or scripts that allow a data dump from a timesheet to automatically assess or build at the first stage of what qualifies and what costs are allowable. And also things like consider replacing dividends with salary for some of the key technical staff that are involved in R&D. Another very important point is looking at the subcontracting relationships. So, electing to being connected with another party may allow businesses to include the real costs instead of actually only allowing 65%, and also assessing contractual terms. So I'm not going to dwell into this diagram, but if you are a contractor that is using third parties for R&D, then consider actually the fact that you may be appointing someone to carry out R&D on your behalf. Therefore, is there an ability to negotiate that part of the agreement? Should that be in the agreement, or should that be reduced from the price that is paid for the subcontractor? And of course, if you are the subcontractor for a company that's asking to do the R&D, then of course you can always be a bit more competitive in your pricing by actually getting a bit smarter with your pricing models, knowing they're going to get a bit of cash back from the government. Just a final slide here about just a case study where a business looked at how to maximize and get the most out of the R&D. They were an Irish and UK business. They looked at the projects in a lot more detail, and they realized there was nearly €500,000 of R&D incentives in Ireland that they did not realize they had, but also actually they were able to utilize the same report and narratives that they were using for the UK and also in Ireland at the same time. And actually, a very interesting thing is this business was looking to expand and acquire additional businesses with a view to exit within a 5-year time frame. But actually, prior to the acquisition of another UK entity, they realized that this business did not actually claim for any of the R&D tax incentives they were eligible to, and effectively they got £500,000 cash back from the purchase price, because within the SPA or service purchase agreements, they were due any refunds from HMRC for prior years, so they got that as a cash back. They also developed, we kind of helped them develop these software scripts that meant for any future years, a data dump of their timesheets meant that a pretty much clear estimate was given, and not only at the end of the year, this was done on a quarterly basis. So even from a reporting perspective, they can actually know on a quarterly basis for budgeting and reporting purposes what these numbers looked like. Base R&D went above the line, which also meant for a business looking to exit within 5 years' time, an EBITDA multiple, an EBITDA number from an R&D incentives that had an impact on their EBITDA number meant a significant increase in their exit valuation as well. And last but not least, of course, the considerations were taken into account as to where contractors were to invoice and which entity would they invoice. So rules in Ireland, for example, would allow subcontracting costs for large businesses compared to the UK that doesn't. So just as a summary in terms of an update, so we see that the R&D tax is likely going to stay, our opinion, will stay post-Brexit, and the direction of travel has been upwards, and I do expect it to increase. I know Sajid Javid, as the Chancellor, when he was the Business Secretary, was very positive and commended the R&D relief. So we can, our perception or opinion is it will stay or increase. Current stats show that HMRC targets are still yet to be achieved, and there's, as you can see, the stats. We actually also had a make survey specific on our R&D, realizing that not a lot of businesses yet are still taking into consideration R&D tax, or even taking that into their budgets. Right? HMRC, however, we know is attempting to implement measures to stop any abuse, and therefore there are certain risk factors that need to be taken into account. But with the current statistics and data that Make has just shared with us, it is, and also thinking of Brexit, it is vital for businesses to carry out proper planning to make sure they do get the most out of the R&D, whether it is through assessing projects, streamlining procedures for preparing these R&D, reducing the risks that HMRC are looking at from an abuse point of view, or enhancing business value, whether it's through EBITDA or multiple jurisdictions internationally. These are all things that businesses can be prepared for to try to soften or cushion any impact from a reduction in the manufacturing and engineering trends. I'm going to pass over now to my colleague Herve. Herve is one of our directors within our innovation technology team who looks after grant funding. Herve.
Good afternoon. Thank you, Eyad, for this introduction. So today we will give you an overview of some of the public funding that are available to businesses that would be effectively beneficial for companies to either innovate or grow. So really quickly, how can you identify a grant funding opportunity? There are some hooks and triggers that would be very useful for you to identify and flag up a grant funding opportunity. So it always starts with an investment, a project with a sound business plan, and effectively a grant is not free money, it's a support for future investments. This investment could be in two different ways. It could be for developing some innovative products and services, for demonstrating that effectively your product future product would be marketed. Key indicators are usually a new pilot demonstration, some patents, and some collaboration with the universities that would actually demonstrate the disruptive nature of new innovation. Also, businesses are eligible for some grant funding that would allow them to support their expansion plan. And usually it's about capital expenditure. So typical examples would be a new relocation, a new site, a new expansion. And it doesn't necessarily need to be disruptive. It's more about understanding what are the future investments to actually help your company grow. A key indicator of that is effectively the number of jobs created that would allow the grant to be received for the business. Just to delve into a bit of more detail of those two types of grants. So the ones I mentioned about capital and growth grants effectively subsidize the company investment. And the idea of that is you develop an asset that, as a result of that investment, you would create and safeguard jobs. We are looking usually at local, regional grants, where effectively the government has provided some funding via local enterprise partnerships or regional development agencies such as Scottish Enterprise for Scotland, the Welsh Government for Wales, and Invest&I for Northern Ireland. And effectively, the idea is to support businesses to even out the economic development in their specific territory. So typically, the applicants would be small and medium-sized businesses, but sometimes some large enterprises may be eligible for those grants, and they would have a lower intervention rate and this is because of EU regulations. So typically you could go up to 1 million of non-repayable funding, but typically we look at a grant from 100 to 300,000 pounds per investment, with a level of funding between 10 and 30%. So effectively, the idea is not to fully fund your investment, but give you that additional funding that bridge the gap between your bank, your accumulated profits, and your ability to actually make the purchase. For innovation grants, we're effectively supporting companies with highly innovative R&D projects to create new products and processes for their market sector. One of the big misconceptions about this is that it's only available to really big and large businesses or very high-tech startups. Actually, any businesses can actually apply for those grants. The idea is to look at what would be the impact of that innovation and how further we push the boundaries of a specific field of engineering. Who can apply? Any businesses in the UK may be eligible for those grants, research organizations, and they actually promote collaboration between businesses and universities, where effectively by collaborating, we actually increase the level of knowledge in the UK, and also some European partners for European grants. It is worth noting that obviously Brexit would have an impact on some of the grants available, especially for European grants, where the main provider would be the European Commission. As of now, any submission to European grants are still available until the Brexit has been enacted, and we've seen a lot of universities in the UK and also businesses successfully applying. Once they've been successful, governments have to commit to the budget, so therefore they would receive those funding available. How much are we looking at? It varies depending on the size of your project, but we can go from 25,000 pounds to 10 million non-repayable funding, and the grant is typically, in general, between 100,000 pounds to 2 million, with a typical funding rate from 25 to 70%. So just wanted to give you a few case studies just to show you that effectively anyone can actually be eligible for this type of grant. We've seen, for example, a tier 2, tier 3 suppliers of large automotive industries that had just been very successful in their businesses and had actually to grow because of the number of orders that have been placed, and they had to invest in plant and machinery. They got from their local enterprise partnership, which was Swindon and Wiltshire, 120,000 pounds over 3 years for a total project cost of 600,000 pounds, creating 30 new jobs. The idea is effectively not only to have that 120,000 pounds, but the grant acts as an enabler and helps the company to secure more investment, which is effectively the ultimate goal of those grants. Innovation grants, it's very interesting to see that effectively the amount that you can receive may be a game changer for some business plans of companies. This early stage aerospace technology company was an SME, and effectively we've helped them to review the application to help them in a competitive process to actually get a successful application. They got a grant of 2.5 million for a project cost of 7 million. This has been a game changer for them because it helped them to also attract private investors that actually thought that their risk was mitigated because of the support of a public body. So the conclusion is effectively avoid risky loans, equity, allow market share expansion, and wider benefits, because obviously you create some operational and environmental savings for the aerospace industry. I'm not going to dive into a lot of details about the type of funding opportunities, but it is related to your sector, and there would be a lot of different funding competitions with effectively applicants providing their applications and effectively receive funding for a specific goal. It's worth noting that the aerospace has a very generous and regular funding competition, such as any technology about new off-road vehicle technology and reduction of carbon technologies as well. The local enterprise partnerships would, from time to time, release some grant funding, and it's always good to have a chat with people that actually know when those funds would be released, because they will make a difference in your particular investment. We've just highlighted a few examples of regions that have actually some funding available, and we can see that Leeds, Solent, the southeast of England, and the Midlands, including the greater Birmingham area and Staffordshire, would actually be greater providers of local grant funding to help business grow and create jobs. So in conclusions, we just wanted to actually make you aware of those grant funding. That would be effectively a really useful tool to consider your investment and help mitigate risk when you're starting investing on new project and capital expenditure. As my colleague said, it is important to look at it in light of R&D tax relief, where effectively there is an interaction that is beneficial. Just to give you a quick update, when we look at an SME, for example, receiving 70% of funding for an Innovate UK project, they would be still entitled to a less beneficial regime for the R&D tax relief, which is the RDEC scheme that my colleague has mentioned, which gives, give or take, approximate an additional 10% on top of the 70%. It means that your project may be funded up to 80% overall, which is a very good way to secure finance in those uncertain times. Thank you very much.